Dirty dealings, corporate battles, consumer woes. This is Evening 5. The Malaysian Anti-Corruption Commission is currently investigating 20 development projects initiated by the Selangor government, which are suspected of involving corrupt activities, said its Chief Commissioner Tan Sri Azam Baki. He explained that the investigation is a follow-up to the corruption case related to sign mining concession involving Selangor Menteri Besar Inc., which also implicates a politician with significant influence in Selangor. It was reported that stacks of cash totaling 600,000 were seized by the MACC during a raid of a rented house of the suspect in the sand mining concession case. While Azam declined to disclose the names of the projects under investigation, he clarified that they are unrelated to the current Selangor administration. Additionally, Azam mentioned that the MACC is investigating 5 companies believed to be linked to 2 individuals who were arrested in connection with the case, along with the influential politician. He said that at this moment, that is all that can be shared, Bernama reported. Commenting on whether the said politician will be called in the near future to assist the investigation, Azam said it depends on the progress of the investigation and if it is deemed necessary by the investigating officer. He added that as of today, more than 18 individuals have been summoned to provide their statements, and he does not rule out the possibility of additional summons or new arrests in the future. Meanwhile, Azam also denied that the investigation of the case was politically motivated. He said that the MACC conducts an investigation based on complaints received, and the investigation will be conducted if it involves a case of public interest. On Thursday, the MACC arrested 2 individuals in connection with the case, including the former COO of MBI and a businessman. Varia has secured a contract worth 571.8 million from the Social Security Organisation, or Socso, to build a rehabilitation centre in Merang, Terengganu. Its wholly owned subsidiary, Pembinaan Teguh Maju, accepted a 30-month contract on Thursday. The date of site possession is set for October 29, 2024, with the expected completion on April 28, 2027. Varia said that the contract is expected to contribute positively to its earnings over the duration of the project. Varia's MD, Dato' Lau Beng Sin, said that the project provides the group with an opportunity to replicate its past track record from building a rehabilitation centre in Perak to a new rehabilitation centre in Terengganu and making inroads into construction in the healthcare industry. He added that the construction of this centre, with its comprehensive medical facilities and related infrastructure, will support Varia's long-term strategies and objectives to become a full-fledged construction services provider. With this win, it bumps up Varia's current order book to 3.08 billion from 2.24 billion as at the end of August. TA Securities expects egg prices to increase by just 2 to 3 cents if the government proceeds with the removal of its 10-cent subsidy, easing concerns of a sharp price hike. In a note on Thursday, the research house said that the potential subsidy removal, which may be addressed in the upcoming budget 2025, could result in savings of 100 million ringgit monthly or 1.2 billion annually. The subsidy, introduced during the 2022 egg shortage, currently caps prices at 42 cents for grade A eggs, 40 cents for grade B, and 38 cents for grade C. Despite the potential end of the subsidy, the House added that the price increases will likely be minimal, thanks to lower production costs and a stronger ringgit. Meanwhile, corn and soybean meal prices, which account for the majority of poultry feed costs, are down by 17.9% and 24.3% year-on-year. TA Securities also believes that major industry players like Leong Hub International and QL Resources are well positioned to manage the impact. As a result, the House views this as a favourable opportunity to acquire shares of Leong Hub, as it expects Leong Hub's performance in the second half to benefit from reduced input costs. Ancom Nylex reported a 36.5% decline in its net profit for the first quarter of FY 2025 to 13.2 million, as its agricultural chemicals business was affected by higher freight costs arising from geopolitical conflicts. This was despite revenue improving 5.8% year-on-year to 515.5 million from 487.4 million ringgit. The company declared a first interim dividend in the form of treasury shares, offering 4 treasury shares for every 100 shares held. MD and Group CEO CEO Datuk Lee Chun Wei said the first quarter performance was rather soft as global supply chains are being reshuffled as producers adapt to mitigate geopolitical risk. On a positive note, freight costs have somewhat moderated, and Lee says that they hope it is a sign that the costs have peaked. He adds that Ancom Nylex continues to make good headway in its new active ingredient as well as its current products penetrating into new crops for the existing markets. On the corporate front, Lee said the recent entry of Helm AG as a substantial shareholder has strengthened the company's shareholder mix and offers potential synergies. Singapore's Temasek Holdings and Saudi Arabia's Public Investment Fund were pointed out by Moody's Ratings as having the strongest intrinsic credit metrics with excellent liquidity and diversified investment portfolios among the 11 government-owned investment holding companies it rated. Intrinsic credit quality is a reflection of the IHC's standalone credit strength without extraordinary government support, according to Moody's. Meanwhile, the rating agency highlighted that Khazanah National, A3 stable, intrinsic credit quality is supported by stable earnings from its key investee companies, which have leading market positions and strong business profiles in Malaysia. It expects Khazanah's market value-based leverage to remain at 30 to 35% over the next few years. However, Khazanah is also among the 5 IHCs that exhibit weak liquidity, with insufficient internal cash sources to meet their cash needs over the next 12 to 18 months, said Moody's, as large short-term debts get rolled over each year. Nonetheless, liquidity risk for these companies is mitigated by a demonstrated track record of strong funding access, including from state-owned banks in their respective countries. Moody's also pointed out that Khazanah and PIF have the highest portion of publicly listed assets among the 11 IHCs rated by the rating agency.